Welcome to the Opening Bell Report.
95%. I want you to sit with that number for a second.
It's a big one.
It really is. If you put $1 into a stock and just 30 days later you had nearly $2,
Yeah.
I mean, that is a life-changing kind of month for a lot of traders.
Oh, absolutely. It's the kind of return that, usually takes a decade of compounding in a normal index fund, if you're lucky.
Right. And usually when we see a chart go vertical like that, we're talking about, I don't know, some obscure crypto coin with a dog on it.
Or a biotech penny stock that just got some miracle drug approval.
Exactly. We're not usually talking about a name that used to be, well, synonymous with those little plastic thumb drives you'd lose in your couch.
It's a really staggering move. It sort of defies the physics of how we think about these legacy hardware companies. It's like watching an elephant suddenly win the 100-meter dash.
That's the perfect analogy. We are talking about SanDisk, ticker SNDK, pulled off a 95% move in 1 month. It's gone from what a lot of people saw as a boring spin-off to suddenly being the hottest AI stock on the NASDAQ. And my first thought, and I'm sure it's everyone's first thought, is this a bubble?
Is it about to pop?
Yeah. Is it about to pop, or is this actually the real deal?
It's that classic market dilemma, isn't it? You're caught between the fear of missing out, the FOMO, and the fear of getting absolutely crushed. And that's a dangerous place to be emotionally.
It's where the big mistakes happen. Which is why today we are not just going to guess. We've got a very specific analysis report we're diving into. It's from the Opening Bell Report.
Yeah.
And what jumped out at me about this source is that it isn't just screaming buy or sell.
No, it's more nuanced.
It's framing this whole thing as a blueprint for the entire market.
That's right. The report breaks down the technical charts, which are, to put it mildly, chaotic. But it also layers in the financials and the market sentiment that's really fueling this whole thing. So our mission today is to unpack that central mystery. Is the party over for SanDisk? Or is this volatility we're seeing right now actually an opportunity in disguise?
And I want to say to you, if you're listening right now, whether you're an active trader glued to your screen or just someone watching this AI boom from the sidelines, understanding what's happening with this one stock, it explains so much about the market we're in right now. It's a perfect case study.
It really is. It captures the psychology, the tech shifts, and just the sheer speed of capital right now. It's all about how quickly the market can re-rate a company when the narrative changes.
So let's get into that, the narrative shift. Because that's what this is, right? A story change. How does a company that makes storage, something we think of as a commodity like wheat or copper, suddenly become an AI darling? Why the explosion? What changed?
Well, according to the analysis, the core narrative has completely flipped. For the last year, maybe more, the whole market has been obsessed with one thing.
Chips. NVIDIA chips.
Exactly. The GPUs, the brains of AI. But the Opening Bell analysis points out something critical, something that often gets, overlooked in the headlines. Those super powerful chips, they are completely useless without massive, fast memory to store the data they're processing.
It's like having a Ferrari engine, but a fuel tank the size of a thimble.
That's a great analogy, yeah.
You got all the horsepower in the world, but you're not going anywhere.
You need the infrastructure to support the speed. AI models are huge. They need enormous data sets fed into the chips instantly. And the specific tech here is NAND memory. And the report highlights that SanDisk is now seen as a pure-play storage company.
Pure play. We hear that term a lot on Wall Street. Why does it matter so much in this case?
It's all about clarity. I mean, think about the big tech conglomerates. They might have a storage division, sure.
Yeah.
But they also sell cloud services or ad space or, smart speakers.
Right, so if you buy their stock, you're buying a mix of everything. A little bit of this, a little of that.
Precisely. So if their storage division has a fantastic quarter, it might get dragged down because the toaster oven division had a bad one. It dilutes the win.
Ah.
But SanDisk, as a spinoff, it's a direct bet. It's undiluted. If you believe AI needs more storage, this is the company that just does that. And institutional investors, they love that clarity because they can model it easily. They know exactly what they're buying.
So they're not buying a messy conglomerate. They're buying a direct ticket to the AI storage revolution. But the report digs into another layer here. It uses this specific economic term, a pricing upcycle.
Yes, this is crucial. If you don't get this part, you can't really understand the stock price.
A pricing upcycle. Break that down for us. What does that actually mean for the business?
It's actually the most bullish part of the whole report. See, the memory market, NAND, DRAM, it's famously cyclical. It's almost like the oil market. Sometimes there's a glut, producers make too many chips, and memory becomes dirt cheap.
And we've seen that.
Yeah.
That was the story for a long time, right?
Oh.
Too much supply.
We just came out of a brutal down cycle, but right now the pendulum has swung all the way back. We are rocketing into an upcycle. Memory prices are just skyrocketing because supply is tight and the demand from AI is well, insatiable.
So it's not just that they're selling more units, it's that every single unit they sell has a much higher price tag.
Exactly. It's a multiplier effect. The report emphasizes that their margins are exploding. Imagine you're a baker. Suddenly you're selling twice as many croissants, and people are willing to pay double for each one. Your profit doesn't just double, it goes parabolic. That's the engine driving this chart.
Okay, that makes sense. The story is solid, AI needs memory, SanDisk sells that memory, and that memory is getting really expensive. But let's talk about the drama, because this 95% move, it has not been a smooth ride-up.
No, absolutely not. It's been more like a rodeo. And the report spends a lot of time on a very specific, heart-stopping event that happened just recently.
I was looking at this. The trap. The stock opens huge at, $425, and then boom.
It just crashed. It wasn't a slow drift down, it was a flush. By midday, it had dropped all the way to $399.70.
That's terrifying. I mean, just put yourself in the shoes of a trader. You see the headlines, you get excited, you buy at the open at $425, you go get a coffee, you come back, and you're staring at a massive loss by lunch.
It's the kind of move that shakes out what traders call the weekends. It triggers stop losses. It creates panic. People think, oh no, the run is over. I bought the absolute top, and they sell. But the analysis from the opening bell report, it calls this something very specific, not a crash.
What do they call it?
A textbook buy the dip scenario.
Textbook. That felt like a panic attack, not a textbook.
Yeah.
How can a drop that sharp be a good thing?
Well, in hindsight, the technicals were perfect. The report points out that the stock opened high. That was the trap. It lured people in at the top. Then the panic selling starts as it drops. But look where it stopped. $399.70.
Just below 400.
And that is the key. The analysis suggests that $400 is a massive psychological and institutional level.
So the smart money was watching that number specifically. Why 400?
Huh.
Just because it's a round number.
Round numbers matter more than you'd think. But also, think about the options market. There's probably a ton of open interest at the $400 strike. The report argues that institutions, the big banks, the hedge funds, they were just waiting. They didn't chase the stock at $425. They waited for it to break $400.
To do what?
To grab liquidity.
A liquidity grab. Okay, what is that exactly?
So when retail traders panic, they sell. Their stop losses trigger. That creates a flood of shares for sale.
And if you're a big fund and you want to buy 1 million shares, you can't just click a button.
Exactly. You'd move the price too much. You need a moment where everyone else is desperately selling so you can quietly buy. So when everyone else was panicking below $400, the big players were there with a catcher's mitt saying, thank you very much, I'll take those. They just absorbed all that selling pressure.
That's fascinating. So they used the panic as camouflage to get in. And the proof is that it didn't stay down there.
It bounced immediately. It ended up closing at $413 that same day. That's a classic V-shaped recovery. It dipped, touched the line, and just rocketed back up.
And that action tells the analysts in the report something really important about the trend.
It tells them the buyers are in control. It tells them they're stronger than the sellers. The report's takeaway is that as long as the stock stays above $400, the trend is, and I quote, hyper bullish.
Hyper bullish, I like that. But it really shows you the psychological warfare of the market, doesn't it? You see $399 and you panic, but the report says that was the exact moment to strike.
And that's the discipline it talks about, recognizing that a dip to a key level like $400 isn't the end of the world. It might actually be the entry point the pros were waiting for all along. They defended that line. It's a fortress now.
Okay, so the technicals say big money is defending the stock at $400. That gives us a floor. But let's pivot back to the business. Charts are great, but do the numbers back this up? The report calls it the financial firepower.
And it is substantial. This isn't just trading on hopes and dreams.
So lay it on me. What are the metrics that matter here?
First up is revenue. The report notes that revenue is up 21%, quarter over quarter.
In a single quarter, not year over year.
Quarter over quarter, correct. That is incredibly rapid expansion for a hardware company. And again, the report makes that crucial distinction. It's not just about volume.
Right. They aren't just selling more. They are selling expensive. That upcycle again.
And it flows right down the line. The report highlights the gross margin expansion. It's hitting almost 30%.
30%?
Yeah.
Why is that number so significant?
Because in manufacturing, margins can be really tight. You have factories, materials, shipping. Expanding to 30% shows that their profitability is scaling faster than their costs. It means they have operating leverage. For every extra dollar they bring in, they're keeping a bigger and bigger chunk of it.
And that's what investors love. It proves they have pricing power in this AI market. They're dictating terms.
Exactly. It turns SanDisk into a cash flow machine, which means they can invest in R&D, buy back stock, build more factories. It creates a positive feedback loop.
So, okay, the money is there, but let's talk about where this is all going. The report mentions some price targets that seem Well, they're all over the map.
They really show the divide in the market. This is where it gets really interesting. The report notes that the average analyst target is sitting at around $300.
300. But the stock is trading over 400 right now.
Exactly, which suggests that the average view on Wall Street is that this stock is massively overvalued. It's run too far, too fast, and gravity is about to kick in.
So the consensus is basically sell. The party's over.
The consensus is skeptical,
Right.
but, and there's a huge but here, the report points out the street high target.
Right. This is the most bullish analyst out there.
And that target is now $580.
580. Wow. That is a massive gap from 300 to 580.
It's a chasm,
Yeah.
and that's where the opportunity and the risk lies. The report is clearly aligning itself more with that bullish view, suggesting that the average analyst hasn't caught up to the new reality of AI demand.
It's just so interesting when you see a gap that wide. It's like two different realities. One group thinks it's a bubble that needs to pop back to 300. The other thinks we're just getting started on the road to 580.
And historically, when you have a technology shift this big, analysts often struggle to model the upside. They're using old models for a new paradigm. The opening bell report is betting that those old models are broken.
Which brings us to the ultimate question for you, the listener. If you're hearing all this, you see the 95% gain, you hear about the 580 target, you're asking one thing. Is it too late to buy?
The million-dollar question. And the report is very specific here. It doesn't just give a blanket yes or no. It actually breaks the verdict down into two different strategies, depending on who you are.
Okay, let's start with the patient people, the long-term investors. What's the advice for them?
For them, the advice is simple: wait.
Wait, really?
Well-
Even with that $580 target?
The report argues the stock is just too hot right now. A 95% run-up in a month isn't sustainable without some kind of cool down. If you're looking to hold this for years, buying at the peak of a frenzy is just risky.
So where should they be looking to buy then?
It suggests waiting for a retest of the $350 to $360 zone.
That's a pretty big drop from here.
It is, but in a volatile stock like this, a 10–15% pullback is totally normal. Healthy even. Essentially let the frenzy die down and then get in at a better value. Don't pay the hype tax.
Okay, that makes sense. But what about the traders? The people who see this volatility and see opportunity?
For them, the advice is completely different. The report says to watch that $400 level like a hawk.
The line in the sand. The fortress.
Exactly. The strategy here isn't to buy and hold, it's to play the bounce. If the stock dips to that $400, $405 range and it holds, that's what the report calls the golden opportunity.
A gold opportunity for what? A quick scalp.
For a quick trade. A scalp back up to the $430 level, you're basically using that institutional support as a springboard. You buy against their defense, put a tight stop loss just below it, and ride the momentum back up.
So two totally different game plans. If you're an investor, you wait for a big drop to 350. If you're a trader, you're staring at 400 waiting to pounce.
And the underlying philosophy for both, according to the report, is the trend is your friend.
I've heard that a million times.
Mm.
But it's so hard to follow when emotions are running high.
It is. And the report emphasizes the discipline needed not to chase that peak. It says, I am not chasing the peak. I am setting my alerts for dips. That's a huge mindset shift. You're not reacting to the green candles going up. You are planning for the red candles coming down.
That is such a key takeaway. Everyone wants to buy when things are flying, but the real skill is waiting for that scary moment and having a plan ready.
And realizing that SNDK right now, it isn't just a stock, it's a proxy for the entire AI hardware trade. It's a barometer.
Okay, so let's wrap this up. SanDisk, the boring storage company that became an AI supernova.
Driven by that pricing upcycle and the insatiable demand for NAND memory. It's the infrastructure play.
We broke down the technicals, that scary dip to $399 that was actually a bear trap.
Showing us that $400 is the fortress the institutions are defending.
And the financials are there. Revenue up 21% in a quarter, margins hitting 30%. There's real cash flow.
But the valuation is the battleground. Is it worth $300? Or is it going to $580? That conflict is what's going to drive this thing for the next few months.
It really is a fascinating case study. You know, this one feels like we're watching a live experiment in market psychology.
It absolutely is. And that leads me to a final thought I want to leave with you.
Okay, hit us with it.
We talked about that huge gap in price targets. The average analyst says $300. The street high says $580. That's almost a 100% difference of opinion among the so-called experts.
That is wild.
Yeah.
These people are paid millions to know this stuff, and they are miles apart.
Exactly. And when you see a gap that wide, it usually means the market is in a discovery phase. It means nobody actually knows what the new normal is. We know AI is big, we know storage is crucial, but we don't know how to price it yet because we've never seen demand like this before.
So we're flying the plane while we're building it.
In a way, yes. And the question for you, the listener, is this. Are we looking at the new normal for AI storage, where these companies deserve massive valuations because they are the new oil? Or is that $580 target just a symptom of a temporary frenzy, a bubble that's bound to burst?
Is this a paradigm shift or is it just a sugar rush?
The charts say one thing, the history books might say another.
Well, there's only one way to find out, and that's to watch it play out.
And to watch that $400 line.
Absolutely. Next time you pull up your trading app, check out SNDK. See if you can spot that $400 defense line we talked about. See if the smart money is still standing there with their catcher's mitts.
It will be an interesting show.
It always is. Thanks for diving in with us today.
Don't forget to like, share, and subscribe for more.